European leaders reach an agreement that aims to solve the continent's economic woes. But is this deal enough or just another stopgap solution? This is Inside Story. Hello and welcome to the programme. I'm Hazem Seeker. Well, after a marathon 10-hour summit held in Brussels, European leaders set out a deal to raise the Eurozone's bailout fund to €1 trillion and implement a voluntary 50% write-down of Greek debt held by the banks. International markets reacted positively, but many analysts say the deal solves nothing in the long term and simply buys European leaders a little more time. Barnaby Phillips has more.
It's not the end of the world after all. In fact, the mood on the markets seems to be one of relief. Because although the deal brokered by Europe's leaders raises many questions, it does exceed the worst expectations.
I think for me and for everyone, it is quite clear that the whole world was watching today to see what suggestions we have to get out of this deep European crisis. I think we showed Europeans that we have found the reasons for the crisis, called the problems by their names and come a step closer to a solution.
In Greece, where it all began, they wait to see what this means for them. Under the agreement, banks are being asked to write off 50% of debts owed by the Greek government. That sounds generous, but we don't know if all the banks will agree to these losses. And the deal doesn't address debt held by the IMF and other public institutions. Still, there should now be breathing space.
I think we managed to escape from this trap. The fact that we're still here today is a big achievement for the Greek people. So today I think we can close a chapter on the past. And I think that now we will start with all our strength to begin to work for a new future for our country.
Europe's banks are being asked to strengthen their reserves with an extra $140 billion. And leaders have agreed that the stability facility, which rescues countries in trouble, is in theory being more than doubled in size to about $1.4 trillion. Breathtaking numbers, but again there are questions. Where will the banks raise extra money? And will the stability facility really work if it's put under pressure? In the long run, Europe needs a path to growth to reduce unemployment. Not just in Greece, but also in Spain, and above all, Italy. The leaders have bought themselves time, a significant achievement, but not the end of the story. Barnaby Phillips, Al Jazeera.
Not the end of the story indeed. Well, before we talk more about this, let's just recap for you the three main aspects of this deal. Firstly, banks will be asked to write off half of their Greek debts. However, this is a voluntary arrangement, so no bank will be forced to take this cut. Banks are also being asked to boost their finances to cover losses occurred by taking this cut. And the European Financial Stability Facility, which was set up last year to bail out countries in the Eurozone, will be leveraged to cover €1 trillion worth of debt. Well, now for more on this, I'm joined by our guests from London. We have Raoul Ruparel, analyst for economic research at the London-based think tank Open Europe. And in Paris, senior political analyst Thomas Clower from the European Council on Foreign Relations joins us. Good to have you both with us. Raoul Ruparel, if I could start with you. Now, we've had months of European leaders offering up a series of what have variously been dismissed as stalling measures and half-baked solutions in dealing with this crisis. They've been under immense pressure then to come up with something more substantial this time. Have they now done that, or is this just more of the same?
Well, I think very much it is more of the same, although there is a big, broad political agreement in terms of some of the key areas, the bank recapitalisation, the Greek bailout, and the leveraging of the bailout fund. If you look at the details, they're very thin on the ground still. So there are a lot of technical issues which still need to be worked out, particularly on the leveraging and the Greek bailout, which could substantially change the nature and the face of this agreement. So until we see those details and see how this is going to be implemented in practice, I think the markets are slightly getting ahead of themselves in terms of the positive reaction that we've seen today.
Yeah, why do you think that is? I mean, is that because their expectations were so low to begin with that frankly they're just glad that any type of agreement was reached?
Well, definitely. I think yesterday and throughout the night there was a significant fear that there would be no agreement or that it would be a complete fudge, as some people have been saying. But you know, so there was a complete sense of relief this morning when there was the announcement and there was some agreement reached. But I'd expect that over the next days and weeks, as people delve more closely into the deal and as the details become more apparent, there will be a bit more skepticism about what this deal actually means, particularly if you look at the Greek bailout. The 50% haircut which bondholders are taking, on the surface it does sound significant, but when you delve deeper into it, you have to question who's actually participating in this, how many of the banks will be putting up the bonds, and so how much debt will be written down. You also have to question, in terms of leveraging of the EFSF, you know, whether it will really meet the 1 trillion mark, whether they will be able to garner the investment which they're keen to get from sovereign wealth funds, from China and some of the other emerging economies. So there are a huge number of uncertain issues here, which, you know, markets will over the next few days pick apart and probably analyse very deeply and become sceptical over.
Thomas Clower, are you as sceptical about this as well, or do you think that this is a step in the right direction?
Well, there have been steps in the right direction, but I share Raoul Ruparel's scepticism about the impact of the deal, and I think the markets have reacted very generously, if you like, and given leaders a blank check. There are vital points of the very complex mechanisms which are now being set in place, or to be set in place, which are still unclear. Until they are clear, we don't know how the markets obviously will respond to them. And going beyond that, there are at least two, I think, very important points, which there are more, but two are clear at this stage, which the leaders haven't addressed. One is, if you like, a new political point. There is going to be an attempt to bring in money from emerging or emerged powers, and there was talk of Nicolas Sarkozy calling the Chinese president. I think it gives off a strange signal for the Eurozone to try to address this crisis by going cap in hand to powers like China, for instance. You can be all for international cooperation on monetary and financial issues and reinforcing that and bringing China into it, but I still think it's very problematic. Perhaps even more importantly, what this deal doesn't do is to address the huge danger that the combination of austerity, of state, of nation state, of Eurozone member state austerity measures, and banks trying to go, if you like, for an individual flight for safety, deleveraging, contracting, restricting credit, jointly exercise a deeply recessionary pressure on the Eurozone economy. Leaders have talked about strengthening growth through structural reform. That's all very well and will have an impact, or might have an impact if it's actually being done in the mid to long term. But there is, I think, there remains a serious danger of the Eurozone going into a recession, possibly a very deep one, over the course of the winter. If that happens, of course, it'll make the whole problems, both in the financial sector and on the bond markets, immeasurably worse. And again, leaders haven't given us any clear indication of how they're going to address this. So my
in your view,
fear
then,
is, or my hunch, that we're going to see more crisis
in your view,
summits.
then, is this just basically postponing? In your view, is this just postponing a potential recession, just kicking the can down the road?
Well, I think they haven't done anything really, anything serious and meaningful to address the threat of recession. Now there is some language in the conclusions that regulators will watch banks' behaviour, but that is very vague, and there's not much meat on that particular bone, and I think it's an absolutely vital issue.
Raoul Ruparel, I mean, you mentioned earlier about the details of this, and the devil is, as they say, in the details, and we understand that that is going to be hammered out over the next few weeks. But based on what we know at this point, do these numbers add up to you, or is this just clever accounting?
Well, I think there is a substantial fear that they don't add up. Let's look at the Greek bailout first off. In terms of the 50% haircut, even the 50% haircut on the bondholders that contribute, that is a very small section of the debt. As was pointed out in the report before, the IMF, the EU and the ECB hold a substantial amount of Greek debt, and they will not be participating in this 50% write-down. There are also a substantial number of foreign investors and pension funds and hedge funds who will not be putting up the bonds for this 50% write-down. So the actual amount of debt which Greece is going to be reducing is particularly small. So the actual level of debt reduction coming from this 50% write-down could be closer to 25 or even lower. I mean, obviously, when we find out the details, we'll have some more clearer figures. But that is a substantial concern. And then you also look at the bailout, which is tied in with this reduction, around 100 billion to help Greece over the next 3 years. Now, if you look at Greece's funding needs over the next 3 years, 100 billion is very much the least that they will need. Now, obviously, this depends on, again, on the private sector contribution with the write-downs, but it seems unlikely, given that Greece has missed its targets over the past year and a half consistently, failed to cut its deficit, and in particular failed to grow at all, that it will be sufficient with the 100 billion. So I think this bailout, in particular, the figures don't add up there, and it's very possible that Greece could come back asking for another bailout or more funding, particularly for its banks, or in the future you could be asking for a bigger level of write-downs on Greek debt, and in that stage you'd be looking at the official sectors being involved again, which could mean losses for taxpayers, which I think would be not only economically undesirable but would be a huge political division within the Eurozone.
Yeah, I mean, you think that's part of the problem here, Thomas Clower, is that the political will isn't really there to really decisively deal with this bailout, and that is perhaps because of what the backlash is going to be from taxpayers.
Well, it's very ambiguous, isn't it? Because on the one hand, taxpayers are obviously reluctant, particularly taxpayers in the countries that have done better in this particular crisis, to underwrite large guarantees and indeed potential transfers into the countries that have the worst public finances and whose ability to refinance their debt on the markets is now seriously challenged, or in fact has broken down. But on the other hand, I think we must really not underestimate the extent to which citizens across the Eurozone and beyond are now genuinely fearful, and rightly so, that if this crisis isn't being properly managed by the political leadership, it could really mutate into a deep economic recession and a breakdown of the economy. And you get anecdotal evidence that consumers are changing their behavior, that people are discussing, ordinary people on the street are discussing whether to try and ship their money to Switzerland or Norway. So I think there is an appetite, or more than that, there is an expectation, a wish, a desire for leaders to come forward with a solution which will finally end this crisis, bring the financial markets back under control, and stabilize the banking sector, and take away the fear that we will see more bank collapses of the kind that we've seen when Dexia was threatened with bankruptcy. And I think it's absolutely vital for leaders, of course, to do this. But I think if they do this, and even if they break, if you like, a few long-standing national taboos on the way, they would get popular support, provided that the solution they do come forward with is actually one that works and is not just another step in a process of trying to kick the can down the road and hope that time will mend the situation, which so far it hasn't.
So what is the bottom line here then, Raoul Ruparel? What needs to be done that European leaders are not doing right now?
Well, I think in the short term, Greece has to default, a hard, full default and restructuring. Obviously, in a managed fashion, you do need write-downs of, say, 60% at least to all bondholders to substantially bring debt to a sustainable level. This will need to be combined with significant reforms and pro-growth measures within Greece. We do still need a bank recapitalisation following on from that, and the steps they have taken in the summit go some way to that, although it may not be quite enough, especially given given the previous estimations that the IMF had of around 200 billion compared to the 100 billion which we're seeing in this deal. And then in the longer term, you really have to look at the imbalances and divergences within the Eurozone. Even if they solve this short-term crisis, the Greek crisis, and stop the contagion spreading to Italy and Spain, you still have to question the measures and the factors which led to the build-up of this crisis. The divergence between Greece and Germany and the other peripheral countries and the core countries. You know, these countries in the south, such as Greece, Italy, will be stuck with a mismatched interest rate, an overvalued currency for a significant amount of time. Now, whether their economies will ever fully be able to adjust to that and absorb it and continue on a sustainable path of economic growth is a huge question over the future of the Eurozone. So, although they may at some point address the short-term issues, although they haven't in this package, there's still these huge long-term questions which are unanswered. And I think, you know, at the moment, there is not really the political will or the economic possibility to solve them.
Well, as Europe's largest economy, the Germans, of course, played a big part in putting together this deal. And we're going to talk about some of that right now. Joining us from Frankfurt, we have Yohen Moebaert. He's a senior credit analyst for Deutsche Bank. Thank you for being with us, sir. We talked earlier about how the markets have reacted to this so far. But how have ordinary Germans been taking this, given that there has been a lot of resentment from Germans over the sense that they are having to bear the cost of other countries' mistakes?
Well, the ordinary German is not very cheerful about this program. He does not understand the programs, he does not understand the details, and he thinks at the end he will pay for the Southern European countries and which are not able to consolidate in an efficient way.
But do you get a sense then that...
That's the mood in Germany.
I understand, but do you get a sense then that while this may be a very a bitter pill for Germans to swallow, is there a sense that they are simply going to have to take this for the greater good of the continent?
Well, if you talk about the politicians, many of them do not really understand what they are doing. They just follow the rules given by their party leaders, and they hope they're doing the right thing. And they have in mind the Lehman event in 2008, and they know if they do not agree, there might be something similar this time. So they always stick to the party leader and agree to the packages, most of them at least.
Thomas Clower, is that something that you see as well? You concur with that?
Well, a lot of these issues are highly complex, and if you look actually at the agreement that was that came out of, or the semi-agreement that came out of yesterday's meeting, which of course needs to be fleshed out, it's a particularly intricate combination of vehicles and instruments. So yes, absolutely. I think all the Eurozone heads of government and state in some cases have had to take a crash course for many of them anyway in how the financial markets work. This has certainly been a factor, a delaying factor in tackling this crisis, and of course we've seen that the German government took maybe longer than others in accepting that a financial crisis of the type that we are living through now creates its own rhythms and patterns and moves faster than the slow-moving machinery, for instance, of German politics. So it's absolutely clear that there is a problem here, but it's compounded by the fact that I think that leaders in many countries, and this is something which I think you can observe in Germany, have not done a very good job at all in terms of explaining to their citizens why they're doing what they're doing, how this works, what the dangers are of failure, and how they will get the Eurozone and their electorate out of the mess. They've held speeches and so on, but there hasn't been, I don't think there's been a single European leader audible, at least beyond his national frontiers, and many instances within the member state in which she or he has been elected, who's been able to talk about this crisis in a compelling public fashion, and that's been a real problem.
Yeah, let's send that back to Yohen Moebaert. I mean, you made the point earlier that Germans are very unhappy about this, but should their government really have made a stronger case that that they are going to have to swallow this bitter pill, and did they really fail to do that? Should they have shown more decisive leadership a lot sooner? Yes,
they should have, and they should also improve their communication. I mean, everybody is looking for, every voter is looking for information what is going on in the financial markets, and politicians have finished up with it and always saying the banks are the poor guys and they are the good guys, but at the end of the day, politicians and bankers have done a lot of not very efficient policies in recent years, and I think they should explain more and should communicate more to their voters what is really going on.
Raoul Ruparel, just in the few minutes or so that we have left, I mean, we've talked a lot about the perceived weakness in European leadership in dealing with these major debt problems for the better part of almost 2 years now. Are we still going to be sitting here a year from now talking about these very same problems?
Well, I think to some extent we will be. As we've seen over the past week with these negotiations, even though we have ended up with some broad political consensus, there have been huge divisions and huge arguments over the past week, particularly at the highest level between the German government and the French government, which are diametrically opposed on some very serious issues of how to solve this crisis, such as the involvement of the European Central Bank or the leveraging of the Eurozone bailout fund. So these issues aren't going to go away, and they aren't going to change their viewpoints. Now, in this current instance, it looks as if the German government has won out, especially since it gives the largest amount of guarantees to these funds. But over the next year, given that this agreement doesn't seem to provide any serious solution, and the details notwithstanding, I believe that it won't solve the crisis. So I do think in the next year we will see these issues rising up again, and I do think the governments will continue to have differing viewpoints, and there will be a lack of leadership, in particular from Germany, who still seems reluctant to lead from the front and impose the view that it needs to have to solve this crisis, or that it wants to have to solve this crisis, particularly as the biggest guarantor of the funds.
Yohen Moebaert, you see it that way, a lack of leadership and a growing debt problem that's simply not going to go away anytime soon?
Yes, I think so. I can fully agree. Maybe this package has gained time again, maybe 12 to 18 months this time. But the structural problems in the banking industry, as well as in government debt, in the unsustainability of government debt in many European countries, are still not solved. So it might be reasonable to expect that it's an ongoing story.
You see it that way as well, Thomas Clower, that the politicians are basically thinking about politics too much and not really focusing on these urgent economic problems?
Well, it has been taking up a lot of their time. So I think in terms of the time spent and that there was plenty of that, the thinking has been lagging behind. Let's see how these measures, which are essentially there to address the short term, play out. I tend to be skeptical, but maybe we'll have a positive surprise. I fear we won't. But of course, then there is the other chapter where they've taken a few steps, but where the main work needs to be done, and that is on how to build a sustainable political framework, a more federal framework, as some call it, for the Eurozone. And there you have an agreement in principle that this needs to be done. Even non-Eurozone member states, such as Britain, egg the Eurozone on to mutate into something like, for instance, a fiscal union, as George Osborne, the Chancellor, called it. But how this should look, how this should work, how to organize the relationship between the ins and the outs, how indeed to build that fiscal union, how much power to give the European Parliament, how to what extent to build it as just regular meetings of Eurozone national leaders. All that is open. And so even if the short-term crisis has abated, we will be here in a year from now discussing how the Eurozone builds a structure which can last over the decades.
Raoul Ruparel, one final question to you, just in the minute or so that we have left. Do you think that this will continue to get worse before it eventually gets better?
I think it will definitely get worse. I think, as we've seen, this bailout package does not solve the situation in Greece, which inherently means that the threat of contagion around the Eurozone will continue to linger. The bank recapitalisation may go some way to shoring up the financial system, but I think it won't be enough, and there will be continuing uncertainties over whether the banks can withstand a bigger hit. And until Greece is fully dealt with, and until the threat of contagion is gone, there will be this spectre hanging over Italy and Spain, these two huge economies which are fundamental to the Eurozone economy as a whole. And if the threat of default or threat of contagion is still there for these economies, this huge amount of uncertainty will be hanging around the Eurozone. So I think things will continue to get worse, and I think the uncertainty is really what undermines the whole situation here. And although there may have been a positive response today from financial markets, in the longer term these seeds of uncertainty are still there, the seeds of doubt, and I think that will continue to raise the problems in the future.
Indeed, and it will be fascinating to see how all of this does play out over the next weeks and months. But for now, we are out of time. I want to thank all three of our guests for taking part: Raoul Ruparel in London, Thomas Clower in Paris, and Yohen Moebaert in Frankfurt. Gentlemen, many thanks for your time. That's it for this edition of Inside Story. Thanks for watching. Remember, you can email us with your comments at insidestory@aljazeera.com. Latest news is up next. Bye for now.